All right, we've got about 2 minutes until we get underway. We are finally streaming with an Ethernet cable this week, so hopefully that helps a few of the connection-related issues that we've been having over the past couple weeks. So 2 minutes and we will finally get into it. Thank you to those of you who are patiently waiting. And again, if we hit 30 viewers tonight, we are going to have an HT giveaway. I feel like I can't give it away that easily. Our numbers were a little lower last week, but I think that's just because of the technical difficulties. But we'll see if we can get up there. We've got 7 right now, and we haven't even started. So we will wait and see. 90 more seconds. All right, we've got 10 seconds to go. Let's just X out of it and get into it. Close that. I think I'll probably have the notification pop up on my computer in 2 seconds here. Maybe not. All right, sounds good. Let's, nope, there it is. Let me click it off. It is on a different screen, which is why you can't see it. But for those of you who are back, thank you for joining us again for another weekly edition of our stock market scan, where we talk about what we've done so far this year, give a quick recap of what happened last week, and most importantly of all, and most relevant to you who are listening, talk about how we're going to make more money next week. But so as to not bury the lead, let's get into what happened last week, and it's going to be a much quicker recap than what we are typically used to, right? Because our plan for last week, as we laid out, was to stay a little bit more conservative in our approach to the market. So that meant two different things, right? I meant one, starting with some smaller positions, and we accomplished that by having a much smaller list of positions, and two, by cutting a couple positions in half, most notably Affirm and Roblox, which were brought down from 15 contracts to 8 contracts apiece, right? Because if you scroll up in our profit tracker, you'll see we typically have much longer lists of positions for the week, but this past week, we didn't really do too much. And the risk that we like to talk about when we don't do a ton is that we underperform a green market. But luckily, our positions that we were in, were well positioned, which probably doesn't say much on its own. But the point I'm trying to get to is that the S&P 500 took home a 1.84% return, and the concern would be that, okay, if we didn't have a lot of our money in the market, we probably would underperform that. And actually, the reality of the situation is that we took home a 2.04% return in the market. So that's 2 really good weeks in a row for us, right? 2 weeks ago, we took home $23,000, and this last week, we took our foot off the gas a little bit and took home what I think everyone can agree to be one of the more stress-free, weeks of profit we have had in a long time. And if we pop over to that year-to-date summary tab, we'll see it has been a whiplash going up and down and up and down and up and down and getting leveraged in and leveraged out of positions. We made the executive decision to say, hey, after last week, after we made $23,000, we were down 11% and the S&P 500 was down 6.5%. We thought, okay, with what we've done, keeping in mind that from the end of January, there was, a 14% gap between our performance and the market. Now there's only a 5% gap. We said, okay, with where we are right now and the amount of time we have in the rest of the year, right, we're pretty much just wrapping up Q1 of 2022. I think we are well positioned to outperform the market with the current amount of volatility. I mean, that is well evidenced by the fact that this gap has shrunk from 14% to 5% as far as underperforming is concerned. And we've really done that despite a few rough weeks in between, right? So we want to take out these big, the 20, the 23, the 14, the 8K lost weeks. And, that is going to be at the cost of maybe not getting 23K a week. But if we look back to what we did in 2021, this, if I go to the year-to-date summary tab that I want, this is really what we're going for, right? From July on is when we took that similar approach in 2021. And, it's almost like deja vu, right? Because 2021, we were up and down and up and down and up and down. And by July, we said, okay, let's take the foot off the gas a little bit. We flattened out the curve, had a nice gentle, return for those last 6 months of the year. And you could see that, visualized maybe a little bit better here by all the different green we saw. And it wasn't huge weeks of green, right? But these cumulatively came up to really nice amounts, right? So from July onwards last year, we took home $38,000. And, as a percentage of the account, it was a really significant percentage because we were trading with a little bit less money back then in July. But now I think that's the same exact approach that we want to trade, right? There's a lot of volatility in the market, a lot of uncertainty, and we could take advantage of that volatility to give ourselves big cushions and, target weeks like this. Now, what we did last week objectively, I get it. It's kind of boring to set up all these trades. And, what I personally would say is an advantage of our strategy is the fact that we could spend probably 5 minutes a week trading and get these results because, I love that, right? We can go outside, we can go enjoy our lives, we can go do other things that are more productive with our time than sit in front of our TVs or computer screens. But it can objectively get very, very boring to sit back and just wait, right? But that's exactly what we did last week, and that's exactly what we're going to continue to do, right? I think one really important trend to talk about is a little bit more macro trend about what's going on in the market. Like if we pull up the S&P 500 ETF that we use to track our performance, SPY, we'll see if it loads here. Come on. There we go. We'll see over the past 20 trading days, it has run up a ton, right? And whereas it kept in the past was bouncing off this lower level of RSI, it has run from 413 pre-market on March 15th to just 12 days later being above 450. That is a crazy jump, and if we contextualize that by backing up to the 180-day chart, it is a very, very big jump in the span of 180 days, and RSI is still elevated. When we see elevated RSI, we typically see the market come back down. Elevated RSI, market comes back down. So now that we're nearing the area where we saw a double top earlier around 458, meaning, it could run a little bit further, but I think the bigger issue and something that we always want to keep in the back of our minds as we're opening positions is the downside potential of trades. And I think there's a lot of downside potential back into this 440 area, which is what I've got my eye on for the S&P 500. So you really want to look at the market as a whole when you're entering positions, exiting positions. If we're up here, right, there's definitely a lot of room to go down. So we want to stay cautious. That's exactly what we've done. So similarly to last week, next week we have a very short list of positions, but let's quickly run through what with us last week. Palantir went fantastic, right? We sold 12.5 strike calls, stayed above 12, finished at 12.94. And while we did lose a little bit of money on the covered calls, we made 880 on the shares right there, netted out to a $540 gain on Palantir. Nice and easy. Next one, Affirm and Roblox. These were really nice, right? These kept running, and it's one of those positions where I know a lot of us in the Discord server have averaged down decently on that and kind of got in a little bit of hot water when it started bouncing very, very sharply. But one of those things where objectively we made $1,600 on those, and we're in very similar positions next week. And I haven't updated the credit to open down here. I'll probably do that live on the stream tonight so we can get an idea of what we're situated at as we head into this upcoming week. But again, $1,600 of profit there. And they pulled back a bit at the end of the week, right? Affirm on Friday dropped 5.89%, and Roblox dropped 7.32%, giving us the opportunity to jump right back into what we had the previous week for very, very similar credits, so we could target this $1,600 return again. And if it drops further, great news for us. That's that quote-unquote opportunity that we've been looking for when we talk about the overall market. If it pulls back, fantastic. That is when we start to push some of our chips into the table. Last week, we were really only using about 34% of our buying power adjusted for margin, and we're still able to come home with the 2.04%. And let me tell you, if we could come home with a stress-free 2% like that every single week, we are going to do very, very well in the market overall. Facebook was a really good example of one of those longer-term cash-secured puts trades. Affirm and Roblox, those started off as long-term cash-secured put trade, but what was the big mistake that we made? we started with 15 contracts and we didn't give ourselves room to average in or manage the position. If it moved against us, those moved very sharply against us, and as a result, we have this big red number so far on the year. But again, we're only down 9.68%. Things could be a lot worse right now for how bad they've been so far. So we're happy with that. We're optimistic about how we're going to be moving forward. But a good example of Facebook, the 200 strike put, we actually sold this at the beginning of February. And we could quickly take you through what happened with Facebook to show you why I like these long-term cash secured puts so much. So when we saw this big red candle back at the beginning of February after Facebook reported earnings, the stock had dropped from 330 down to about 240, I think is when we entered. So we saw a stock that was very, very oversold, right? RSI was getting down into that blue area. We love to take advantage of when stocks get into the blue. However, it kept sliding on us. But when it was at 240, we sold those 200 strike puts for $4 a piece, right? So the gap that we had was still pretty significant. Even though there was a huge red candle, we still had this gap between 240 and that strike price at 200. So what do? We wait. And even though it kept moving against us, and at the low point, it got down to 184, meaning that we were looking at a decent loss on what we had sold. That long-term expiry, that April expiry that we had sold, let us just sit back and wait. And lo and behold, what goes up must come down sometimes, and what goes down must come back up sometimes, right? The market looks a little bit wavy from a long-term perspective. Sure, there are trends up, there are trends down, but from a 1, 2, 3 month perspective, you're going to have some opportunities to get in and get out of trades, and that's why I like these long-term cash secured put trades. So over the last couple of weeks, as the market has rebounded, Facebook has come back above not just 200, but 220, closing at 221.82 on Friday, and we were able to close this out for $1.53, about a month ahead of schedule. And during the week, that netted us $447. But overall in the trade, I think we took home, if I could find the number. Where's the number for Facebook? There we go. We took home about $319 on the trade. And another point to make, since mid-January, we have the big losses from Affirm and Roblox, and we have one credit spread that didn't go our way. But if we highlight all of these and scroll down since mid-January, we have not lost on a normal trade. That's 41 for 41 for a sum of $7,000. If you exclude that, it's a sum of over $8,000. So from just our regular bread and butter option selling trades between the HT wheel, IV reversion, and earnings, we're up $8,000 since mid-January on a 100% success rate on the new trade. So that is how effective these volatile market conditions have been, and how much opportunity we have as option sellers in this market. And it's that's kind of the big reason why I've decided to take my foot off the gas a bit and say, you know what? Let's just target some base hits. Let's get 3,000 back at a time, and let's slowly close this gap right here between us and the performance of the market. And I'm very confident that we're going to be able to do that. But next one, Draftkings, the stock dropped. This one actually turned out pretty much perfectly for us, right? We sold an 18 strike put, and this was a great example of why we sell covered calls and why we do it in the money sometimes, right? Because Draftkings had bounced up a good amount. We wanted to stay conservative, so we sold an in-the-money covered call. And the one thing that we want to say always about those in-the-money covered calls is that we should view them the same as out-of-the-money cash-secured puts. So if I was going to sell a cash-secured put on DraftKings, where would I sell it? And the answer was an 18 strike. But further, this is one that we've been playing for a while, right? At that 325 18 strike call. And we have gotten our break-even price down from 36 at the end of November down to 20.98 before the end of last week. And this isn't even updated yet for what we just did, right? So we sold 20 more, and these are going to be, let's see, we could type this in right here. We rolled the 18 strike. This worked out really, really well for us. We rolled it out to next Friday, April 1, another 18 strike. Remember, we closed these for a 14-cent debit. And, oops, yeah, no, that's correct. And let me check really quickly in our Discord server and see what we sold the new ones for. And we sold the new ones for 82 cents, right? 0.82. And, we could put our little formula in here. So equals, oops, did not mean to do that. Equals max. Let's see, it's going to be 18, or it's going to be F2 minus 18, comma 0. And there you go. That gets us the price, right? So if DraftKings finished Friday at 18.20, these would be worth 20 cents. Thank you for bearing with me as I clunkily updated my spreadsheet. So what we've done here, right, is this amount is the extrinsic value in this option. Because if it finished at 18.20, we know that it would finish at 20 cents. We sold it for 82 cents. So there's 62 cents of extrinsic value on these right now. And moreover, right, there was more than that. There was 68 cents when we sold it, right? A 68-cent credit, which should be a direct reduction to our break-even price. So if we drag this down right here, we'll see that we're going to collect $1,240 off this 18-strike call if DraftKings just stays still for the upcoming week. Or goes up, right? As long as it stays above 18 for the coming week, we're going to make $1,200 off it. That is why we're selling these, covered calls that get us as much extrinsic value as possible. And further, on 325 last Friday when we did this, it brought our break-even price, right? It should be, since we sold for a 68-cent credit, it should be this minus 0.68, 20.3. Let me test that theory really quickly to make sure I did that properly. And that did... whoops, that's why. Yeah, there you go. Zeroes you out right there. So that is our new break-even price, 20.3. Let's further go back to get there. Okay, and so all in all, it has been basically 3 months, right? So we started this thing November 26th. Last Friday, we adjusted it March 25th, and that's pretty much been 3 months, right? So we started with DraftKings at $36 a share, and as of last Friday, our new break-even price is $20.30. So in just 3 months, we have lowered our break-even price on DraftKings by about $16. And it's one of those things where right now it may look a little bit, you may get a little bit impatient. Things may look a little rough because, we sold 18 strike calls. We can't sell these for 20.3 yet, so we can't technically break even this week. But we're going to keep driving this lower until this number gets lower than 18 or lower than the covered calls that we're going to be selling. But big picture here, right? We've played this position for 3 months. DraftKings is down 49%. Yet we were right around breaking even. And that is the value of the strategy that we're putting into play here. We can take a look at the DraftKings chart to, hammer this point home a little bit further. Because the drop that this thing has seen is nasty, right? We thought we were being patient. After it dropped from 64 to 36, we thought, okay, this is a really good place to get in. It's taken a really big fall, fallen 50% from the highs in just a matter of months. But, another important lesson for people who are going to be trading long-term in the market is the fact that things can always get worse. And they did. They got much worse, right? It got below 15 at one point on us, which represented like a 65, 66% drop. And anytime you have a 65% drop on a stock that you have a bullish position on in a 3-month period, you are going to be in some hot water. But thanks to the aggressive amounts of premium that we've been collecting, we're looking okay. And we do get the question a lot, we, especially back on March 18th, right? Because we lost $1,800 on the calls that we sold. But the reason that we lost that, if we'll recall, is because the stock went up so much. So it was a net win for us on the week. But we'll get the questions like, oh, why did I sell this covered call? Oh, no, I lost money this week on it. And people will get a little bit upset. And, it makes sense because when you're looking at your brokerage screen, it's going to show you this call. You're going to see a big reg number to it. And objectively, if you didn't sell that, you would have had more money. But we always want to have the longer term, bigger picture in mind. And if we sum up everything that we've done from a covered call perspective, when we took assignment of these back at the end of January, the net amount of premium that we've gotten, even with this $1,800 loss and the $400 loss, is still $11,000. So just over the past 2 months, we are $11,000 better off thanks to the covered calls that we have sold on DraftKings, and that is why we do it. So we're going to continue to do that, try to bite off, $1,000, $1,200, maybe $1,500 a week. And our strategy right now is you'll notice we're selling 18 strike calls. Those are below our cost basis. And so long as our cost basis is above the price of the stock, we are going to continue to do this, selling these at the money covered calls, because at the money covered calls have the most extrinsic value, and the more extrinsic value you get, the faster this number drops. So the idea is, whether this is 2 weeks, 3 weeks, 4 weeks, 2 months from now, is once our break-even price drops below the price of the stock, we will have sufficiently played defense, and we can get a little bit more aggressive with these, right? Because profit and loss, and we'll show this a little bit later in the stream as we talk about what we have set up for the upcoming week, Anything above 18 is the same for us. So DraftKings can go up 50% this week. It won't really matter to us. We'll make just as much money as if it stayed dead flat. So the idea is that once we get enough premium collected to get our break-even price down below the stock price, that's when we get aggressive and put ourselves in a position where we can make money off a potential rebound, because there is definitely a long way for this thing to come back up. But again, short-term perspective, we know that it's been down to 15 before. We know the market's a little overbought. If things turn south, I want to be protected against a further drop on this stock. So that's what we're going to continue doing. Hopefully in, maybe end of April, maybe in May sometime, we are going to be having a fun conversation about how we're selling calls $2 or $3 out of the money and still collecting premium and dropping our break-even price while giving ourselves upside on the trade. But that is a bridge we'll cross when we get to it. All you need to know about DraftKings is it's dropped 50% on us in 3 months, yet we're still very, very close to breaking even on it. And we're going to continue with this strategy until this number is below the stock price. So thank you for bearing with me on my weekly DraftKings rant. It is now time for the Fubo Rant, and this is, one of 2 positions we have left to discuss in our recap of last week. So, for example, why did I say for example? That doesn't make sense. Next, we have Fubo, which is really the only position that went against us for this past week, unfortunately, as the stock dropped over $1. Again, we had these covered calls, and this is why we sell the covered calls, because instead of a $2,100 pure loss on the shares, you net that out against what we had on the covered calls. It's only a $720 loss. And again, you net all these positions out. You put all these smart positions into play that have really sufficient cushions and really big premiums, and it nets out to a good week. You can afford to have 1 or 2 positions go against you a week because you're getting 500 from Palantir, you're getting 1,600 from Affirm and Roblox, you pick up 500 from Facebook, DraftKings nets out to $1,000, and you can afford to have something lose $700. That's just how the market goes. And when we talk about position diversity, having 1, 2, 3, 4, 5, 6, 7 different positions in a week, that's what we expect. We quite frankly do not expect every single trade that we're in every week to go our way. So this is just part of what happens. It's annoying that a stock dropped this much when the market was up 1.84%, but guess what? That's part of the game. Hiding the losses would be dishonest, and this is just a realistic expectation that we all need to have as traders in the markets. The important part is, what are we going to do to play defense on it? And again, the stance I've taken over the past week, and this is similar to what we've been doing with DraftKings, is I just want to objectively do the best trade I can each week. And now Fubo is one that has just, exploded on us, down 60%. We're still down a decent bit on us, and I need to update this. So it's not this bad. I still have a couple weeks that I need to update this actual tab for. But big picture, it's down a ton on us. So what are we going to do to get this money back? And this is where the sunk cost fallacy really, starts to come into play. There's some big short interest on Fubo, so it's definitely potentially bound to spike at some point. But I'm never going to be somebody who has a bullish position on something just because I think there's going to be a short squeeze. I just, long-term trading perspective, I just don't think that's a smart way to play a bullish position. That's kind of like getting in a little bit of playing the lottery type odds right there. So with Fubo, what we did for the next week was these expired worthless. We sold some 7.5 strike calls, which I'm going to need to update the premium for when I get into what's going on next week. But that one slipped away from us a bit. Had it been higher, we would have made, about $1,000 more and been above $4,000 on the week. But hey, that's not what happened. So we just take what happens. We set our positions up as we set them up, and we accept all possible outcomes. This was a possible outcome. That's okay. Rest of our positions took care of it. And the very last trade I want to talk about is Newegg, which is a fantastic trade. It was an IV reversion trade. And we actually have this tab here, Pivot Table 4, which is going to tell us how using this tab right here, our trade performance tab, because we track type of trade here. But we are, where is it? Where'd it go? I got lost. There we go, Pivot Table 4. Our IV reversion trades this year are 10-0. For a $2,400 profit. And we really, especially when the market is overbought, we really love to lean a little bit more heavily on the IV reversion trades. Why is that? It's because they're disconnected from the overall market, right? So if you think the market's going to pull back and you're worried about the market going down, an IV reversion trade is great because you get some of the biggest cushions there are, and the performance of the stock, once it starts behaving in a way that, makes it an IV reversion trade, really detaches it from that market performance and takes away overall market risk. So again, 10-0 this year, and you might say, okay, it's only March. Like, that's great and all, but how good are these actually? And if we go back to 2021, I've already pre-sorted this for you guys. Our IV reversion trades were 36-2. So we have made, since the beginning of 2021, we have made, 36 plus 2 is 38 plus 10. We have made 48 different IV reversion trades, and 2 have lost. And we made 17.3K from these IV reversion trades in 2021. And so far, we are up 2.4. So that's $20,000 of profit on these IV reversion trades. And this is basically a 96% success rate. So, all that to say, I loved the Newegg setup, and this is a trade setup that we love to go for, and we will go for every single time. And what's been great is I can pull over our Discord server here really quickly and talk about what we are doing to help identify these. Actually, let me explain the trade first, and then I will talk about how we're identifying these. So let's pull up Newegg. And again, there's 4 main criteria that we like to look for in an IV reversion trade. The first is a big spike in the stock price. So if we go to the 20-day chart, there you go. You see a big spike in the stock price back on March the 22nd. The second thing is a big spike in implied volatility as a result in the spike in the stock price. So you see the big spike right here. And while it's not as big because you've got some weird, I think these are just flat out incorrect implied volatility readings. If we zoom in on this section, you'll see it a little bit more clearly, right? The big spike in stock price creates this big spike in implied volatility, which is plotted with the blue line under the chart. So what does that mean for us, right? When implied volatility goes up, it normally comes back down. It reverts back to the mean, thus the name IV reversion trade. And that's exactly what we saw, right? As the price comes back down, and it doesn't even need to keep going up. If it keeps going up, great, because our price target is wherever we sell puts at. The further we get away from our price target, the better. We're good to go. But the reason we love this so much is that with a spike in implied volatility, you get a spike in option premiums. And we're probably going to have to take a look at April expiry, so we're not going to be able to see it as clearly. But let's take a look at the 5-strike put, because 5 is what we sold, right? A 5-strike put for 15 cents a premium is just over a 3% ROR, return on risk, for the week, which is fantastic, right? With our individual trades, we typically like to target just 1% ROR for our standard stuff. But with these IV reversion trades, you're able to cut off a little bit more right here, which is fantastic. But a good way to visualize this, if we go to more info, TOS charts, and we can plot the price action of the stock, or of the option itself, right? If we go to a 10-day, and let's bring the stock chart in right next to it, right? So we'll type in Newegg. We will also bring up the 10-day chart. And sometimes these kind of get thrown off a little bit. Like this is 321 right here. This is 321 right here, right? So it's not really one-to-one. I don't know why these things are never like exactly one-to-one. Here we go. 3-3 right here. Let's see. This chart starts at 314. Where's 314? It's right about here. Whatever. Moral of the story, right, was on March 22nd, there was a big spike from 545 to 656, which created a subsequent spike in implied volatility. And again, that day was March 22nd. So if we go to March 22nd over here, you might not be able to see it as well, but right here, this is that spike. And what this purple line is the theoretical option price. And what that means is, in theory, very basic, if the stock goes up, it's good for calls, bad for puts, right? So if a stock goes up, and again, we're looking at the 5-strike put, then in theory, the price of the put should be going down. However, what we see is actually a little bit of a departure from that. Whereas the price of the stock goes up, the price of the put also goes up. It rose from 25-ish% up to 45%, which is doubling in price despite the stock going up, right? Despite, in theory, the fact that the puts should be decreasing in price. So what this allows us to do is pick a strike that's very far out of the money and get a good amount of premium right here, as we can see that this spikes up a little bit. And again, this is the April 1st expiry. The March 25th expiries, the effects of this were a little bit more pronounced. They're a lot easier to see, and I think we have some screenshots of it in the Discord server if you're interested in digging those up. So what did we do? We sold a 5-strike cash secured put with the stock in excess of $6 a share. I think the stock was trading at about $6.20 when we did it. And what did we get? We got 15 cents for it, meaning that we sold 20 of them. we would get $300 as long as Newegg stayed above 5, which is a pretty good value prop when it's trading at $6 a share. Which leads us back to one of the other things that we like to look for in the IV reversion trade, and that's some sort of a trading base, right? Because if a stock shoots up and you're like, oh, I'm going to sell, 5 strike puts, but, a week ago the stock was at 4 or 3, that might not be a very good idea because it's a very, very good chance it comes back down. But for our situation, if you look at the 10-day chart here, 5 compared to where it shot up at, yes, this is a little bit riskier because it had bottomed out at 426 back on 314, but we figured that was 10 days ago. There were 1, 2, 3 days till expiry. You count 1, 2, 3 days back. The bottom right here is pretty much right on 5. So that was the justification that I used on that one. So we sold 5 strike puts, and wouldn't you know it, 5 was a fantastic number to pick. And that's the great part about these cash secured puts, right? When we sell them with an IV reversion strategy. Yes, we entered when the stock was at 620. Yes, a cash secured put is a bullish setup. But despite the fact that the last 3 days of the week, the stock was red every single day, it stayed above that $5 watermark that we set, right? As long as it stayed above 5, we were going to hit max profit. And did it get a little bit dicey at one point Friday? Absolutely it did. But we trusted the numbers. We trusted the fact that we looked back and saw there was a little bit of a hop off the 5 level. We thought that would act as support. Sometimes the big round numbers, although there's no fundamental basis for that, sometimes psychologically they can, especially on Fridays when people are selling options, that can act as kind of a price that these stocks get pinned to. But, was very happy with 5, and it played out fantastic. So despite the fact that we opened a bullish trade and the stock dropped significantly for the next 3 days, we still had max profit. That is why we love the IV reversion trades. That is why year to date they are 10-0 with $2,400 of profit. And that is why 2022 is not just a outlier sample. Back in 2021, there you go. They were 36-2 and made us 17.3K. So that is why we love that setup. And now the question is, right, we have these spikes in implied volatility. This is a very sudden thing because right after the spike is over, it reverts back down to the mean. And when this blue line comes down, it absolutely kills the option premium. And that's how we make our money. So the question is, how do we find these trades when they come? How can we find these 95%, seemingly free money IV reversion trades? And I'm very hesitant to use the term free money because there's no such thing as free money in the market, but this is as close as we have found so far. But how do we find what I should maybe better term these high probability setups where we've made a very, very good amount of money? And the answer is what we've been working on is a bot in our Discord server that alerts people to them. We have this IV reversion scanner. So we have all sorts of different things, right? Throughout the day, it'll alert you. And if you are not a member of our Discord server, you could join hourglass-trader.com. And there should be a link to join our Discord server on there. But we have this automated bot that alerts you every time there's a setup like this in the market. And what kind of sucks about this right now is everything that hits the scanner comes on here. And it's not always a fantastic result. Sometimes you have to do a little looking into it. Sometimes, okay, I don't know what this is. Maybe I don't know what this is. I have to do a little bit more research. What we've been working on and is going to be deployed at some point this week, either Monday, Tuesday, Wednesday, depending on how the test day goes, is a new and improved IV reversion tracker. So what we've built, if we go up here a little bit, it's buried, is something like this. So whereas before it looked like this, where you just get the stock, it just lets you know it's on the tracker. And again, with these tags, it basically comes to your phone as a text message. These are time-sensitive trades, right? This spike happened in a very small time frame. You need to be able to jump on these. That's why the alerts are important. But instead of looking like this, we have developed something that we're about to put into operation that's going to look a little bit more like this, right? You're going to have the name of the stock, company name, current price, sector. So if it's a Chinese or like a crazy stock that you probably wouldn't want to play, you would be able to find that right here without even having to do the extra research. If it's very high, we talked about Newegg, right? If it had been trading down at like $2 or $3 the previous month or so, I probably wouldn't have wanted to jump into that. There you go. It gives you that info right here with that 52-week range, so you can see how high off the bottom it is. So from a 1-year perspective, you could see what that immediate downside is, so you could quickly make that decision of whether or not you want to potentially pursue that trade. But again, these updated, improved, hopefully, IV reversion alerts are going to be rolled out in the Discord server this week, along with some improved stock halt alerts. So that is going to be project 1 and 2 as far as our alert bots are concerned. And then I think a little bit further down the line, we might want to add some more, but it'll definitely take toying with the scanner a bit to see, what alerts and, what types of setups and situations we might want to be interested in. But we have built out the framework for it. So now that we have it, fully tested and hopefully deployed this week, adding more is, the easy part, right? Getting it initially built out was tough. Adding more is going to be pretty simple. But that is the plan for the Discord server and the alert bots this week. Let me pull the profit tracker back up, and that is it for the recap. We had a pretty short list of stocks, but despite that, the recap still took us about 40 minutes to get through, or 30 minutes, right? We started 10 minutes late. Apologies. But, that's the idea for what we did last week, and a lot of those ideas, a lot of those positions are very similar as we head into the upcoming week. So I'm going to take a quick sip of my water, and then we're going to get into what we are holding for the upcoming week of March 27th. All right, we are back. So step one, we're probably just going to update this profit tracker live because, the way that we like to evaluate our positions every week and what kind of a position we are in as we head into Monday is what would our profit and loss look like if, the market was dead flat. And last week, the answer was something like this, right? I think we were sitting at like a 2.5% return if everything that we held on to finished dead flat, and Fubo moved against us a bit, so we finished at a 2% return. But this is a great example of why we like to take this method to evaluate what we have for the upcoming week, because a lot of the time it kind of rings true, especially when you're setting yourselves up with some really, really large cushions, as we have been for the past couple, or at least for the past week. So targeting another stress-free week, let's go down the list. Palantir, 12 strike calls. Give me 1 second. What did we roll these for? These were rolled for a 13-cent credit. We bought to close for 88 cents up here. 94, whatever. And we sold these for what we'll call a 12-cent credit. So it's going to go for 12 cents higher than that, meaning $1.06. There we go. So there you see it right there, right? So our extrinsic value is what our profit is going to represent on the week. So we're going to want to put that max, let me think right here. This minus 12, the strike of the call, comma, 0. And there you go. That's going to give you the intrinsic value, meaning if the stock finishes right there this week, that is what we are going to make, right? $240, right? Because we rolled these things for a 12-cent credit. We have 20 of them, so 12 times 2 is, 240. I should say 120 times 2. So nice and easy, as long as Palantir stays above $12 a share, that's going to be $240. So that's not a ton, right? That's not a ton, because last week we got 500, and we're still playing these things relatively conservatively. But the reason I like this is because of the cushion it gives me, right? On a 1 week basis, our break even is going to equal that 12 minus the 0.12 of extrinsic value, meaning our break even is going to be 11.88 on the week for this position. And with the stock at 12.97 at close on Friday, that is a 9.56% cushion for us on Palantir. So we're perfectly happy to do that, right? Even though this isn't a ton of money, right? A bunch of base hits are going to get us where we want. And most importantly, this downside cushion with this volatile market is really what we're trying to get after. Because we know that the market isn't going to be green every single week, right? 1.84% following a 5.67% week is massive. We could pull up this SPY chart again and, further hammer that point home. But especially over the last 180 days, look at the market. Take a step back, right? We don't typically take straight lines, especially this steep up, right? The last time we really had this steep of a rise was maybe back in the end of February when we bounced from 410 to 437. But within another few weeks, we were already right back down to 413. And then maybe the last time before that was when we bounced from 426 to 460. And again, we double topped, but again, a month and a half later, they were down to 410. So I'm very, very wary of where the market is heading. How do we combat that while still reconciling the fact that we want some long positions? This is the answer. 240 a profit, 10% cushion. Let's let that position ride. And then next we have Affirm, which, and I should probably update the expiry date on this to go 1, 2, 3, 4, 4, 1 is going to be the April strike. And Affirm, we rolled these things for, let me look back, an 84-cent credit. So that's going to be 0.84. There you go. And if Affirm stays perfectly flat, we're going to hit max profit on that during the week. So there you have it. And again, we could go over here and update our break-even price tracker. It's going to equal that 37 strike minus the premium we've got of 84 cents, meaning our break-even on the week is 36.16. With the firm finishing at 42.16 last week, that is a 14.63% cushion. So again, basically a 10% cushion on Palantir, 14.63% cushion on Affirm, and that 14.63% cushion, meaning as long as Affirm doesn't drop 14.63%, we're going to make $672. So two very big cushions, while Palantir was kind of lower at $240 a max profit. Adding up that Affirm at 672 gets us to 912. And, now we're talking. We're going to get a little bit further down the list. This number is going to get bigger, and we will see what position this puts us in. And this number needs to be updated to roughly 162. Our denominator changes as we calculate our weekly return. And let me quickly zero that back out. Okay. Moving further down the list. Now we're going to talk about Roblox, which we, again, had the opportunity to roll down to the same exact strike. Roblox, we rolled down and out. We did not roll it down. Why did I say we rolled it? Oh, we did roll it down and out. We rolled it down to a 44 strike put. And we did so for a 95-cent credit, which is fantastic, right? So there we go. Another one where we're getting a similar amount of profit, 760 right there. And the best part of all is, what is our break even, right? It's going to equal that 44 strike minus the credit we just got of 95 cents. And all of a sudden, we've got a 43.05 break even on a stock that finished last Friday at 47.07. 4.53% break even price. So again, not as big as the last two. That's for sure. But again, a 4.53% break even, or I guess a 4.53% cushion on the week. Not too bad of a proposition if we are worried that the market is going to drop. Facebook, we closed that position, so let's delete that row. Draftkings, 1814, that price rolls down here, and we rolled these 18 strike calls. Let's see. We bought to close them for 14 cents, and we sold to open them for 82 cents. So we're going to put 82 in there. And again, we are going to put this little equation where we go equals max 18, max the stock price minus 18, the strike of our call, comma 0. And what this equation, does at a high level for people who are not as proficient and try to use Excel or Google Sheets to track their profits is, what do we know about an 18 strike call? We know that if it finishes above 18, meaning that if the Draftkings shares finish above 18, for example, 1814, what are these going to be worth? They're going to be worth 14 cents. So what this equation does is it says, okay, if this number is above 18, let's take really what the difference between 18 and that number is, which in this case would be 14 cents. So what happens is this basically maps out our max profit on the trade, and we're collecting 1360 of profit just off of the extrinsic value in these calls. And the great part about this is, this 1360 is our max profit, right? As we mentioned earlier, if Draftkings ran all the way back up to 25, this equation nets it back out to 1360. So this kind of automatically updates for us during the week. So that is why we like that formula, because it helps us not only identify where we are going to finish the week at, but also, it makes it so we don't really have to update anything, right? Because we could fetch the price of the shares with the Google Finance function, and then as long as we have the intrinsic value of these options in here from a formulaic perspective, this is going to just self-calculate during the week. So there we go. With Draftkings, that's a 1360. That's the biggest one yet, right? So again, we have 240 from Palantir, 672 potentially from Affirm, 760 from Roblox, and now 1360 from Draftkings, and all of a sudden, we have a potential $3,000 return on here. And Draftkings, what do we want to do here? Affirm, Roblox, let's type in Draftkings. Again, our break-even price is going to equal 18 minus the premium we have on the covered calls, which I have to click over here for, which is 82 cents. Meaning our break-even price, let me think, that's not correct. Yeah, it is correct. Our break-even price is 17.18 on the week. If we throw this Google Finance function in here and pull the tickers in, copy that formula down. There we go. Our cushion on DraftKings is now 12.5. Oh my gosh. I've been doing this wrong the whole time. These amounts have been, the values have been copied. I feel like an idiot. Man. Okay. So we have to recalculate this. I was doing some of these things. The numbers didn't seem quite right, but we'll see. So the cushion here is going to be calculated as the stock price minus the break even, meaning the gap that you have right there, divided by the stock price again. So there we go. Our cushion there is 8.4%. Our cushion has been downgraded. Bummer. Here we go. Let's copy this down and see what our real cushions are. Okay, so not too far from what we were at. Again, I was saying that Roblox number. I was like, 4% seems a little small for a Roblox cushion. But great news, it's an 8.5% cushion. So again, we're accomplishing these goals that we set out for, right? We wanted to be very conservative in the sense that we have some big cushions coming up. But again, we still want to make some money, which is, probably applies to every single person on the planet, right? I want to make money in the market, but I also don't want to get crushed if it goes down. Very, very inspirational HT. But again, great cushion here. DraftKings, the smallest of the cushions so far, right? A 5.6% cushion. But again, 5.6% is a decent amount objectively for 1 week. And if it stays flat, we're getting the biggest gain of the bunch. So that's the trade-off right there. And again, we talked about that DraftKings trade earlier in the context of what we're trying to do overall. We're really aggressively trying to bring this break-even price down. So I'm happy with that, right? That brings up Fubo. And Fubo, unfortunately, was the one that turned against us. So what did we do with Fubo? We could have kept that 7.5 strike that we had last week where there it is, the 7.5 strike call. However, again, another position where we're wary of what the market is going to do. So I just wanted to get the most premium that I could on a covered call. And where does that premium lie? The answer is at the money. So we sold a Fubo 4-1 7 strike call. And I probably need to delete 7.5 right there so this doesn't look ridiculous. We sold it for, if I look back at our trade log, we sold it for 29 cents of premium Friday afternoon. So again, what do we have here? Another $580 of profit, or $580 that we're getting no matter what. And that's the great part about these calls, right? We're getting this extrinsic value no matter what. Could we incur share losses that outpace this number right here? Absolutely. That's just a risk of investing. But at the end of the day, this that we're looking at right here, if I delete Newegg because we are not currently playing that. Actually, we do have one more position this week, and it's CGC. So I could put that in a second after this. But again, let's build up what we've been talking about, right? We have 240 from Palantir. We've got that Affirm. We got the Roblox, DraftKings, and now Fubo covered call premium. And all of a sudden, that's $3,612 of potential profit for the upcoming week, just provided that the market stays dead flat. And then the last trade that we added for the past week was CGC, cash secured puts, right? So we've got CGC, where these go, CGC. And I believe we sold 6.5 strike puts. And we sold those for 11 cents. So decent from an ROR perspective right there. And again, CGC is far above, and I should probably put the dates in here as well. It's going to be 4-1 also, 6.5, and maybe a little lowercase p right there. So it is consistent, but there you go. Another $110 right there. That's a new trade technically. And this is our setup for the upcoming week. And we could finish this exercise out here really quickly, right? Fubo, our break-even price is going to equal 7. Or it's actually going to equal the price that the stock started the week off at, so $6.95 minus the 29 cents of premium we have right here for a $6.66 break-even price. So similarly to DraftKings, we have a 4.45% cushion right there. CGC, if we do that, this updates automatically. And again, we have 6.5, the strike we sold, minus the 11 cents of premium we got right there. And all of a sudden, there we go, a 26.47% cushion. So that is why we entered into that CGC trade. And this kind of replaced that little Newegg row that we have right here. And there are some similarities between CGC and Newegg. We could pull the chart up for CGC really quickly. What's interesting, again, a really big spike in the stock price. It's almost in the same IV reversion type vein, right? Big strike in this, or big spike in the strike price, the stock price. Good lord, I guess we're getting to that time of the stream where I just cannot speak. But big spike in the stock price. There you go. It fell back down a little bit, but again, IV during the day on Friday was elevated above where it typically is, right? It normally sits around this 9-ish level. I mean, maybe you could go a little further back and say it sits around 1.1, but again, it objectively sits below 1.3, so we expect that the implied volatility is going to come back down. I believe, since this is a marijuana-related stock, there's some sort of legislation going to the floor of the House on Monday, which is why this is spiked up in the first place. But again, we think about that 6.5 strike put. It's a pretty big cushion that we have right here, and if we were to get assigned at a 6.5 strike, this is kind of in line with where it's been trading over the past calendar month, so I think this is one that I'm perfectly okay with. Even if we go back to the last 180 days and extend this line to the left, it's not a bad price to be owning this stock at, so we're going to keep hanging on to that. And if we get assigned, we get assigned. We'll run the HT wheel. We'll knock that break-even price down aggressively. We started the position small, but really, really great premiums here, right? Even if you wanted to get in now, we were able to sell these for 11 cents. They've already fallen back down a little bit, but again, that's still above that 1% ROR that we like to look for on a week-to-week basis. And that really, really big cushion makes it all the more attractive, right? The biggest cushion of the week for us right there, 26.47%. So there we go. We have updated our trades for the upcoming week. This is what we've got. This is our quote-unquote base case, right? Because this is being calculated as if the stocks stay dead flat. So with this, if the stocks stay dead flat, it's a 2.29% return, which is fantastic, right? If we get a 2.29% return in the market every single week, we are doing an incredible job, and we are going to close this gap that we have with the market in no time. And more importantly with that is, even with this 2.29% return, we're not really extending ourselves that much to get it. Because what we go back to right here, how safe is that 2.29% return? The answer, I think objectively, it's decently safe, right? Of course, these things can move against us. Of course, the moves on these stocks can outpace the cushions we have. But when the average cushion that we have is 11.28% across the 6 trades that we're in, we could handle a lot of downturn in the market. That is just a fact. So really not too worried about what's going on the upcoming week. Again, this would chip away a little bit further, bit by bit by bit, and get us down back near potentially breaking even on the year. And I imagine, even though the market's been ripping back upwards, I imagine we pull back down a little bit. And the goal right here, I've created this column over here because what we want to focus on is the gap between us and the S&P 500. I've said it a bunch of times that, look, we could lose money in a year, but as long as on a percentage basis, the overall market loses more money, we've done our job. Our goal with what we're doing with our strategy is we're building a long-term, consistent approach that outperforms the market. And I believe we absolutely can do that on a consistent basis. There are several advantages that retail traders have. And one of the biggest ones is that you could sell options and change what you sell options in and move your positions around every single day, and get yourselves cushions like this and returns like this. Quite frankly, institutions cannot do this. They can't afford to move in and out of trades without significantly affecting, the pricing of the options or anything like that. With the amount of money that the retail trader has, that is one of the advantages we get. Another advantage is margin, where if you look at something like that Facebook trade that we had, while it would have been $20,000 fully cash secured, it only took us $19.55 to sell that position. So on that Facebook trade, even though it lasted 7 weeks, it was still a 16.32% return on capital, which annualizes to over 200%. That's a fantastic return. That is another advantage, using that margin to leverage your cash a little bit and get some really nice returns. The flip side of that is what happens when you get into Roblox and Affirm and oversize your positions. But, we've learned our lessons there, right? We're going to start a little bit smaller. Sometimes the most expensive lessons in the market are the most important. And we've got a good long-term approach that I think I'm very positive about. And we've got Emily G in the YouTube chat. Welcome back, Emily G. I hope you are doing well also. Long time no see. Welcome to our Sunday night market stream. But again, this is what we got for the upcoming week. Definitely want to take a peek at the scanner to look at a few more things, but I don't think we're going to find a ton because the S&P 500 is still a little bit overextended. I think it's very overbought. And we're not going to see a ton of great opportunity until we get one of these, 2 or 3 red days in a row. And when we do, we are going to be ready, right? We are using a very small amount of our buying power. Yeah, that's courtesy of some of the leverage that we're in right now. But Again, great advantage of margin is you could use smaller chunks of your account. You can only use a third of your account, still get this 2% return, and have plenty of room to keep the show running. So, and again, I think the point that I was trying to make, that I kind of cut myself off a little bit. You know, I tend to do that when I'm talking to myself in my bedroom. There's no one else for me to cut off, so I just cut myself off sometimes during a train of thought. This performance since inception tab, right? We talk about all the time. Our main goal in the market is just to outperform the S&P 500, and this is how we have done since inception. And again, you know, at this point in 2020, we were up a very, very good percentage, but it just wasn't publicly tracked. So honestly, if I were someone who had just joined our group and said, oh, you know, you were up 50%, you don't have the numbers to back it up, you know, I think that was kind of BS. So fair enough. I will start our thing dead flat from June. And even from that dead flat point, even from the worst trade we have ever made with Hyliion, where we dipped back below, over the past, what is coming up on 2 years of publicly tracked trades, we have sufficiently outperformed the S&P 500. You know, big down swings like this have taught us some big lessons, and of course, we would love to eliminate those in the future. But as of where we stand right now, we are cumulatively at, you know, what are we at right here? 123% return in the market compared to 48% from the S&P 500. We have over doubled the return of the S&P 500 during a pretty big bull run in the market, which is, you know, the risk of our strategy is that we cap our gains, and when the market is running, that we're going to underperform. But I think we have sufficiently mitigated, you know, that risk, and we have the publicly tracked and traded numbers to back that up. So, you know, where is this going to be 1, 2, 3, 4, 5 years from now? I have no idea. But, you know, using the strategies we've talked about tonight, taking the foot off the pedal a little bit, you know, targeting, you know, 2% in a week is not modest, right? Because if you compound 2% a week, you're going to make a ton of money in a year. But, you know, targeting these from a best case scenario perspective while keeping a lot of buying power free and setting yourselves up with some really, really big cushions in the market is how we're going to accomplish this. But let's start talking about what else we could potentially be looking at. Obviously, I love everything that we're in for the upcoming week. It's always great to have positions over the weekend, provided you have sufficient cushion, because we always potentially worry the market could come back down. And futures right here, as you can see, they're down about a quarter of a point. And horrible news, Mahir is letting me know that he just lost $50 betting on the Lakers, which I think means that the Lakers lost, which is horrible news. They were playing the Pelicans tonight, and they were up by a ton. I started the stream, and I think it was like 98-98. I knew the Pelicans had come back, so I was maybe optimistic that I would get off the stream and find out that the Lakers had won, because they're battling out for the 9th seed in the West right now. But, you know, Mahir keeping us honest, letting us know that is not the case. The Lakers suck right now. It is wildly frustrating, so hopefully this will cheer us up next week if this comes to fruition. But again, building on this, right? So we have the 2.29% return that we're set up for. But again, this is a very short stack of trades. We talked about it earlier, right? We normally have much longer lists of trades for the week. So what do? During the week, we'll maybe add 2, 3, 4, 5 different positions that can maybe bite off 3, 4, 500 more bucks. And if we add maybe 15 to 2,000 or 1,500 to 2,000 more dollars of potential max profit, this then looks like a very, very good weekly number. So we hang tight, we pick our spots, and you know, we rest assured knowing that we could not make a single trade this week, and this is what we're set up for. We made literally one trade last week, and it was adding Newegg to add $300, and we still took home $3,000. So again, that's why we love the strategy. We spent maybe 5 minutes trading last week, and we took home $3,000. We're in a situation right now where we could spend 0 seconds trading this week, and this is what we're set up for, and it's a very successful long-term strategy. But let's talk about maybe what could be the next Newegg. Now, since those are alerted in our Discord server via, you know, alert bot and our very specific setups, we're not going to be able to find an IV reversion trade because they show up at random. We just need to make sure we do the best we can to be alerted to when they show up. But let's go through the normal scan that we go through, right? We're going to pop into the high ROR puts for the upcoming week. What this is going to pull in is in the next 7 days, the highest premium in the market. And if you want to learn how to make this scanner yourself, I think we have a video up on our YouTube channel about how to do that. So there you go. You got Tilray, right? We already have CGC, which is in a similar industry as Tilray, that weed stock, so to speak, industry. So I'm going to leave that alone for now. AMC, GameStop, if you want a position And, I can't, I almost want to stop myself here because I can't believe I'm saying this. But if you want a position that is disconnected from the market, I don't think AMC is a horrible place to be right now. And we can pull up the chart, right? Because, fundamentally, this goes against everything that I believe when it comes to like valuation of stocks and like, what things should be trading at. But sometimes the numbers just look a little bit too good, right? So 12.9 is the low when that market bottomed out at like 410 a couple weeks ago. And it's almost up 100% since then. So that's a pretty decent bounce from AMC. However, we look at the scan, we see that there is a 9.42% ROR on the 20.5 strike puts. Lesson number one when you are evaluating these scan results is just because this is the first result on here doesn't mean that the 20.5 strike put is what we're going to want to sell. We follow the logic of saying that if the 20.5 strike put has a 9.42% return, then we could probably go much further down the option chain and find a decent return. And again, we just want 1.00% ROR a week on these things. And where can we get 1% ROR? The answer is with the 16 strike put. The MMM right here, which is another great way. We use it for earnings a lot, but when things are moving like crazy, it's also a decent way to evaluate potential range of a move. But it's sitting at plus and minus 2.52, which would get you down to like, 1770? Did I do that math right? Yeah, 1775 would be the low end of the move here, implied by this market maker move. So that'd be, let's zoom in right here. 20-day chart. 1775 would be the low end of the MMM, which is right here. But again, one of those things you look to the left on the chart and there's some serious downside risk below that. But what do we want? We want a 1% ROR. We could pretty much get that with 0.98% at the 15.5 strike put. So the 15.5 strike put falls right here. That is a very decent cushion on this type of a stock. Now, what I will say is the thing is so volatile. It goes up, it goes down. I'm not a huge believer in the big short squeeze thesis that everyone always wants to talk about. But I would wait for a red day on this one because if we scroll back, can we scroll back? We can't really scroll back. We're going to have to get 180 day here. When these things do randomly spike up, because they do spike up, it happens a lot. I mean, I think AMC more than any other stock in the market is prone to just randomly have a green candle. But when we see these big random green candles, what do they normally, follow? Or what are they normally followed by? We see a big spike up here back in October, but it fell from 43 back down to 34, but it spiked back up and then it fell back down, and then it spiked back up and then fell back down. Big spike, immediate drop, big spike, immediate drop. So we see a big strike or a big spike here. I would maybe look for a red day back down to the 18-ish level. Let's go a little closer to see what we can see. Yeah, maybe back down to where it was trading over here back at the beginning of March. If we can get a fall back down to anywhere, I'll call it 19. If we see red on Monday back down to 19, I'm going to revisit these 15.5 strike puts because implied volatility is starting to spike back up again. What do we know about IV? When it goes up, it typically comes back down. However, we've seen much greater IV on AMC, so this is nowhere near the max, right? And if you go to our 1-year chart, we have this thing script that tells us the IV rank. And, from a 1-year perspective, obviously, because in the past year, it was when it had that big spike up, so implied volatility is nowhere near what it used to be. But when things get like this is when we love to sell options super far out of the money. But with that said, things can get much, much crazier. But again, they could also get much worse because I think this thing's kind of destined to go back below 10 at one point. So the golden rule of option selling, do I want to own something at 15.5 if I think it's going back below 10? That's a tough question, and I will answer it if we see 19 on AMC come Monday. So we keep moving down the list here, right? Chewy's another one, which is in that like Ryan Cohen bucket of like pumped stocks that people are begging for short squeezes. Let's just take a look. Let's do our due diligence. I don't want to let a good opportunity pass us by. This one may be a little bit better because I think at some point it was like a legitimate company as opposed to like GameStop or AMC, which are more of like an idea in the market, so to speak, I guess I could say. But we back it up a little bit more here, right? We're on the 1-year chart. Let's go to 3 years. I think maybe downside here is probably back low 30s here where it was bouncing off of initially. So move back into the 180-day chart here. We see 1, 2, 3 bounces off of this 35, 36 level. We know that there's a lot of volatility right now. We know that there you go. Volatility is very, very high on this one. If we back this thing up to the 1 year, There you go. This is a little bit higher, right? Where we saw with AMC, our IV rank was 15. With Chewy, our metrics for IV are much higher, right? They're 71 and 93 percentile, and in plain English, this tells you what it means, right? 93% of days, 93% of days, trading days over the last year, there was lower IV. So if we look at this from like an IV reversion perspective, there's definitely a lot of room for the IV to get sucked out of this and come back down. So it's bounced off 36 3 different times. We know there's a lot of IV in it. Can we get any option premium at that 36 level? The answer is absolutely we can. They have a $6.36 move in the upcoming week. They must be about to report earnings. There's no way that there's that kind of option premium in this right now. Give me 1 second. March 29th. Yeah, why? Oh, this is high ROR puts. What I need to do is high ROR puts without earnings. There we go. Filter the earnings out. There we go. Run the scan again. Hand up. My fault right there. There we go. Tilray, AMC, Game. We've got Rig. Never really heard of Rig. Let's see what's going on with Rig. And that is absurd, right? So when we talk about the big spikes in volatility that have the big spikes in price, and yeah, we could look at this and probably go 5 strike. We can go all the way down to 4 strike and get a 1% ROR. But again, 4 still relatively elevated when this thing was trading at like 250 at the beginning of the year. So I don't know if that's something that I'm really a big fan of. That's something I would throw off the list and not really look at again. Root, a 2-strike put. This is one that was shorted like crazy back when it was trading in the teens, I think, at one point. Yeah, there it is. But bottomed out at 130. What kind of premium are we looking at right here? Looks like 6.83% at the 2-strike. This thing was trading at 130. Like there's no reason. Oh yeah, and I mean, back on March 15th it was trading at 130, 12 days ago. So there's no reason you would want to own this thing at like 195 with that adjusted basis. So on to the next one here. What do we got? Nothing crazy, right? And again, we're looking over in the ROR column and we're seeing 4-5% ish. And what do we know, right? We know that we want to target like 1%, 1.5%. So we could just skip the line, right? Go back down here and try to pick out and see if we see any stocks that look a little bit stronger to us, right? Maybe Workday, maybe Overstock. That's offering 1.8. PayPal maybe at 112. GPS, Sofi even. I think Sofi is a great one to look at here. So let's take a peek at Sofi. You know, that area of the scan is really where you're going to find a lot of your better ideas. So this thing dropped off 4.86% on Friday, which is, great for us because it brings RSI back down on a 20-day perspective. Let's zoom the thing out on 180-day. And this thing is really fallen off of a cliff. They got their bank charter and they moved all the way up to 14, and people thought that they had won. But, with the former SPAC, and if you're trading it above 10 a share, and unless you've sold your position, you have not won. So that's where it's currently sitting right now. Let's take a look at the option chain. We could get 1% ROR down to 8.5. I'm kind of so on that. And why is that? The answer is 1. I think, 850 with an adjusted basis of like 835 would be a great place to hold Sofi. The issue that I really see with this one is that the MMM right here is 55 cents, meaning the bottom end of the range is like 845. Meaning, I don't really think there's enough premium in these to cover that potential move. And further, I think one good way that we should identify short-term downside potential is back when the market bottomed out a couple weeks ago, we see lows on a lot of these stocks that we've pulled up. That low probably could be a good way to view potential downside for the coming week. But maybe if, the futures are minus 0.35% right now, if we get another red day out of Sofi and we could get 1% ROR on these 8-strike puts, I think that's a great move right there. I think that's a decent move. If we can get like an 8, 9, or 10 cent fill in there, try to take another $100 of profit home. I think that's a very, very good place to start that position. Because if you get a 10-cent premium on an 8-strike put right there, you're gonna have a 790 basis off the bat, and that 790 basis, if I didn't screw up and hit futures trader, is right around here, right around the lows on the stock. So basically, from a 1-year perspective, you would have Sofi at a price that pretty much no one really has it at. So 8 is a good place to get in on this. One that we definitely want to keep on the list if the market does continue to keep turning downwards. Let's keep looking a little bit further. What kind of big names do we see on here? Charge point, where that was a former SPAC, 17.5. Again, we don't really want to touch that above that 10 level. Let's see what else we've got. Let's see what else. Nothing too crazy. So let's get into my favorite scanner feature. Actually, one more. Let's do a little stock hacker scan, right? We've been talking about the implied volatility on stocks. We've looked at IV rank, IV percentile. And instead of just pulling stocks off that first scan and saying, oh, well, look, guess and check. We guessed a stock off this list and the IV percentile looks great. The IV rank looks great. Let's just directly scan for that. So let's go to load scan, personal, HT IV rank scanner. We are going to run that scan. And if you want these scanners, the way that we're pulling these in here, just loading them in personal. And you'll see a little bit more utility with these as we keep going through the scanners. Hourglass-trader.com links to every single scanner that we use on the stream are available to HT Premium members on our website. So here we go, right? We've got IV percentile now, and we can see these are optionable. And two things that I think are really important for scans are, one, excluding all futures, because you'll get some really weird like futures or commodity contracts that get thrown in and just make your results a little bit messier. And two, we want only stocks that have options. Because really, it's a waste of time if you find something and you're like, oh, this looks great. Let me go find out what puts I want to sell, and there are no puts to sell. And this is also equally useful because sometimes IV percentile gets jacked way, way, way up because of earnings. You could see the icons here for earnings. So if it doesn't have a little icon here, there are no earnings. And further, if you really didn't want to mess with earnings at all, you could just add that scan filter. But let's kind of move down the list here. Maybe sort this by volume a little bit. See what we can do here. So higher volume, let's see if we can get a little bit higher. 84 right here, EQT. Let's take a look at EQT. Now it says it's oil and gas, which as we know with like overall macro trends, we know what's going on with gas prices. We know what's going on with oil prices. So I think what we're about to see when we look at EQT is not going to be a great setup, which is why we have this column here to help us more quickly identify, good and bad trades. But let's go through the exercise. Let's type in EQT. EQT. It's getting late. Yeah, and there you go, right? This is exactly what you would expect. A 1 year perspective, or 1 year, 1 year perspective. I did the right word right there. I don't know why I tried to correct myself. But yeah, from a 1 year perspective, if you look at the next front option expiry over in April, decent option volume, which is great. That's what we get from this option or the volume column right here. But where could you really sell, right? April 14th is 1 to 3 weeks away from today. So what we would really want to look for here, if we wanted a 1% ROR per week, is a 3% ROR. Where can we find a 3% ROR? The answer is it's at 32. This seems like a horrible deal because 32 is right here. Not even close, right? I can't even let myself finish a sentence. Like a month ago. So if we go 3 weeks back, right around here, it was trading at 25, which would represent a 100% loss. That's just far too much downside potential. But that's the point of scanning, right? You throw a few things in there. You take a peek of what's going on. Bed Bath & Beyond, they report not next week, so 4/13. Let's take a look at BBBY. We played an IV reversion trade on this very, very successfully when it jumped here, right? If we go to our little profit tracker here, one of our better IV reversion trades of the year, Bed Bath & Beyond, there you go. We made $640 off of a 17 strike put off this initial jump. And our break even was indicated by this red line. And that is why we love the IV reversion trades, because so often it doesn't fall all the way back down, especially when there's perceived good news that causes the initial spike. This is why we like those. And this is why we want to get alerted to these trades, because it's it's like shooting fish in a barrel a little bit. And we could have even made a little bit more money if we held out, but we had the chance to lock in some decent profits. So, smart investing, yada, yada, yada. Conserving your capital. That's what we did. But moral of the story here, similarly to Newegg, this was like Newegg on steroids, right? A huge, huge, huge jump in the stock, 100% pre-market even. And you see a huge, almost doubling in implied volatility as it goes from 118 up to, 2. So that is what we love to look for on these, and we are going to take that setup every single time. But further, implied volatility is still elevated on a 1 year basis when comparing it to the rest of the year. So volatility is still there, but the answer is, where would we really want to sell something? Maybe with like a 19-ish strike looks okay here. If we have a little bit of resistance at 19, there's a gap right here as well. I don't really love that. 19 is where you get that 1% number, but I don't think I could see myself owning Bed Bath & Beyond at 19, especially when we see some really, really harsh short-term downside potential there. So not a ton here, but again, the idea, I wanted to quickly look at that because the idea is we looked at high ROR puts, we looked at some IV rank stuff. Something else we could do is also look at oversold stocks, where if we scan for these and we sort low to high on RSI, we're going to get some very, very sold off stocks. And again, these are all optionable, right? You get like something like MUNI. I have no idea what this is, but since it showed up on this scanner, we love RS. Good Lord, what am I doing? I'm hitting all the wrong buttons here. MUNI. Yeah, I mean, this thing's fallen off a cliff over the past year, and this is what it looks like, right? It pops up on this RSI scan. So when RSI gets in the blue, like we really like to enter because, typically things don't go down in a straight line. What goes down must come back up, and what goes up must come back down, temporarily at least, right? So that's why we like to look at RSI as a potential setup. Now, if we can have some sort of intersection between, low RSI, high implied volatility, and decent option premium, that makes for a really, really good setup. So what we do for that is we go to scan, we go to option hacker, we go to high ROR puts without earnings, because this kind of accomplishes two things, right? We did run the stock scanner to show us IV rank that shows us situationally high implied volatility, which is useful, but typically in those situations where there are situationally high levels of implied volatility, there's consequently high option premium. So you're really killing two birds with one stone with this. You're kind of already capturing that population of stocks with this. But now part two of this is, instead of having this list of 886 different stocks, how can we cut this list down a little bit and get a more focused scan? Something where if we are looking for a setup like this where we want really low RSI because we want something that's potentially going to bounce, how can we get high premium and something that's going to bounce? And the answer is on this intersect with feature. So we're going to go to personal, we're going to go to oversold stocks, and it's going to intersect these two scans together, right? This list with this list, and we're going to run the scan. It doesn't always give us results because this is a very specific setup, and I find the more specific the setup, the more specific what you're targeting, the more successful the trade, right? We actually set this up a couple weeks ago for the first time with Snow and I believe it was Shop. Where are Snow and Shop? Calling Snow and Shop. And there you go. And the result was we made $542 off that scan. So I think from a profit perspective, it was a very worthwhile exercise. We could show you what was happening with Shop, right? We could show you Shop first. Again, 180-day RSI. Got down into the blue and it got to an intersection of where, it was oversold and there was high premium on it. So we were able to, if you go to the actual position we took, we sold 360 strike puts, which was all the way down at this red line. And from like a shorter term perspective, it was a massive, massive, massive cushion, right? If you looked at like the 20-day chart, you had to zoom pretty far out to get down to that 360 level. But again, why do we love RSI as a technical indicator? Because as it got down into the blue, as those two scans intersected and this potential position popped up, Shop bounced from 510 to where it settled Friday at 679, which is a massive bounce. And because of that, we didn't even capture all the bounce, right? These 360 strike puts, we got out of them for 380. And I think the expiry on those, when was those? 422. If you look at 422, those 360 strike puts are now trading, like the midpoint of this is like 50 cents. So we would have got another, $300 off those if we just kept holding. But again, you're never going to go broke taking a profit. That's not something I regret. It's just more to further the point of how effective some of these RSI based bounces are and how quickly, they could turn that option premium close to zero. Because again, that April 22nd expiry is about a month away at this point, and these things have gone from 750 when we called them out down to 50 cents now. That's almost 100% of it in roughly 2 of the 6 or 7 weeks that the trade was supposed to take. So that's why we really, really like this setup. The other one that you saw on that profit tracker was Snow, which had a very, very similar setup, right? The RSI got into the blue, huge, huge, huge bounce back up to 220 at one point, and that just slaughtered the option premium. Took it from didn't kill it as much as Shop, but it took from 22 to 134. And this is another where if you actually look at what we sold, we were able to sell 100 strike puts for May. 100 is all the way down here. Like the cushions that this scanner, like these setups that come from the scanner, some of the cushions that we're able to give ourselves from maybe a 1 or 2 month perspective are fantastic. And that's why kind of bigger picture, I like to think of this as maybe a long-term cash secured put scanner. But either way, you can still go short-term, medium-term, or long-term with these. The setup is the setup. But with the snow, right, we sold May expiry, 100 strike puts, and these are now down at like 40 cents. So if we held on to those, that would have been another $200 for us. So again, not to make the point, the purpose of that is not because I regret closing, but just to further how effective the results from this scanner are. And right now we have one option on this scanner, and it is Herbalife Hlf. And you could already bet that I've already taken a look at this because I love this scanner. But again, here's what we got, right? We've got RSI on a 1 year period down at 26. We have implied volatility basically at an all-time high. IV percentile is 99. IV rank is 92. 250 out of the last 250 trading days, implied volatility was lower than this. So what does that imply? It implies that it's probably going to start to fall back down and crush the premium, the seemingly temporarily elevated premium on these options, meaning we are going to make money. So if we take a look at the Herbalife options, we start short term, start small, look at the current week. You get 1% ROR down at 29, which, I don't know, how's this thing moving on a week-to-week basis? Let's go to the last month of trading. It's moving a lot, right? I mean, if you look at what was last Monday? March 21st, it opened at 33.69 is where it opened, and it finished the week at 31. So it had like an intra-week drop of about 350, which from here would take you to like 28. So I don't really think this premium does enough to cover that. But again, what I like about this is it's kind of like the long-term cash secured put scanner. If we wanted to go out to that 40 to 54, and again, we like this 45 to 60 day window, because when you're selling out of the money cash secured puts, one, with this longer window, you're going to be able to get a bigger cushion. And two, theta decay for options that are out of the money is slightly different when you are, theta decay is slightly different for options that are pretty far out of the money. And in the sense that it ramps up and actually becomes a little bit more exponential in nature at that 60 to 45 day window. So this is really what we would target in line with that theory, right? A May expiry cash secured put. But one, not a ton of volume, but that's not a huge issue because, limit order is your best friend. You find a number that makes sense for you and you set it and forget it. However, the bigger issue for me is that this is going to be like a 2 month trade, right? So 2 months ago is going to be what? The end of January, which is right around here. From then to now, Herbalife has dropped 45 to 31. That's $14, which is really a third of the value. If it lost another third of its value, it'd be down to 20. So I don't think 20 is out of the question yet. If you get on a 20 here, there really isn't much of a return. We can maybe look at 25, stick that at the midpoint, and look at what our margin buying power would do for us. And this is why we love these, particularly because normally this trade would take $24,000. It takes $2,500, and $550 of profit off $2,500 is it's a 20% return on capital. And if you do that over a 2 month period, presumably there are 6 2-month periods during the year. If you get a 20% return 6 different times during the year, you are going to have a very, very good return. But again, we don't want to over leverage our account and be in these like insanely leveraged positions. We want to start small, maybe a contract or two, and have multiple of these going at once. So that's the idea there. But again, at 25, I'm just not confident that this is like a home run. There is nothing about what I've seen on this chart over the past year that suggests to me, it can't get back down to 25. We can maybe back out to the 3 year. I mean, yeah, look at this. Bottom of COVID, this thing got down to 21. 25 would be right around here. And I think from a technical analysis perspective, that 25 number looks okay, because that's where the bottom of this candle is. There were a couple bounces below it. We could call COVID a little bit of an anomaly. However, it looks like the last support level was right around here at 33, and it broke 33 with the big red candle. So, I'm not a huge TA guy, but that would lead me to believe, especially with how rapidly it's fallen from 45. I don't think 25 is out of the question. And when I open trades like this, I want to put it at a number that I think is out of the question, a number that's so hilariously low, I would be thrilled to take assignment at. So for Snow, that number was 100. I thought this is hilariously low looking at the last 3 years of this stock. With Shop, the number was 360, which is absurd for where the thing had been trading since the bottom of the COVID crash, right? That would have been assignment at a basis at the bottom of the COVID crash. So unfortunately, nothing right here, but this might be a good one to actually set up one of those alert bots for in our Discord servers. So we've got whatever here, right? We've got one for IV reversion stocks. We've got one for stock halt alerts because very similar, right? You get big spikes in implied volatility when options are halted. So this is one we're also going to improve, but maybe having one, we could maybe call it a long-term cash secured put scanner to alert to when something comes up on here as well. Because this is definitely a very lucrative scanner that we have set up right here. So that maybe is something we'll throw on the list. But again, no results here really. We can maybe quickly take a look at what's going on with options. And C. Dobbleman said hi to the stream, so I might as well pull that on, give him a shout out. What's going on? Always happy to give the the HT fam a shout out on the stream. But moving to the earnings trades that we have potentially coming up right here. Everyone say what's up to Borat. We've got, not a ton. Earnings season is coming up. Is the market closed on Friday? What is Friday? Why are there no earnings on Friday? I don't think it's closed on Friday. Would anything be happening Friday? No, I don't think April Fool's is a national holiday, but I could be wrong there. But, all that to say, not a ton going on from an earnings perspective. We're getting right back into the midst of earnings season. Which is fantastic because we always love trades when the market is overbought. We love trades that are disconnected from the overall market. IV reversion trades like we talked about before are, and I think earnings trades are the other area that we really want to target when we feel that the market is overbought and we want to focus our capital on trades that are a little bit protected if the overall market pulls back. And this is where we want to do that. However, just not a lot of big names that are reporting in the coming week. What I could maybe take a peek at is Micron. Lululemon. We looked at Chewy earlier. I wasn't really a big fan of that. And maybe BlackBerry on Thursday. But let's take a look at Micron first. Let's see what the chart's been doing. And we could go through that process that we go through and we evaluate earnings trades. So let's start with the 180 day. And let's get these out of here. Remove this drawing. Remove this drawing. So from a 180-day perspective, could be better, could be worse, right? It bottomed out at 65, but also peaked at 98, so it's trading kind of in the middle of that range. Earnings for Micron, as we saw from this little handy-dandy graphic, are going to be Tuesday after market close. And the MMM that we see right here is 6.40, and shout out to Marvin in the YouTube chat. What's going on, Marvin? We've got a 640 MMM right here. So what does this mean? It means that based on Thinkorswim's little secret formula that calculates the expected move for a stock during the upcoming week, we could expect realistically that Micron would move in a range of plus or minus $6.4. So up 6.4 from here would put it to about, 84.50? I think that math is right, 84.50, which we could plot right here. And then down 640 would put it down to 72, 71.70. Someone check my math on that, 71.70. Oops, that's 70. Remove that drawing. 71.70. And there we go. We could extend both of these to the left and see what we can see, right? So what we do when we extend these to the left and we look at the chart on a 180 basis is say, okay, so this is the potential range that we could expect Micron to move into. Let's take a look at the top end of the range. Does it line up with any critical levels of, support or resistance? And I think the answer here is maybe. Let me get some new handy-dandy drawing tools out right here. Where are my drawing tools? Give me the arrow. Where is the arrow? Boom. So one right here. One right here. These are two little areas of resistance. However, the other issue I see is back in this period, I can hold down control and choose the arrow direction. What's going on right here? I don't think that's true. Is it? What happens when I hold down control? Why won't it let me? This is a disaster. Thank you for... It's telling me I can do this, I feel like I'm being lied to. for the benefit of everyone else, I'm going to stop fighting my computer right here. But again, we see two little peaks right here on the chart, which conceivably, these happened on, January 26th and February the 3rd. So these happened much more recently than this little bit of chop that I'm concerned about in the period from November to mid-December. However, what was more recently even than these two peaks was this massive red candle back down through this perceived level of, resistance turns into support, bounces off, and there was a huge red candle that cut right through it. So is this really going to be a level of resistance, or is this going to act as a pretty big gap from 87 to 82? From that perspective, I think there's a little bit too much uncertainty on the upside to play any sort of bearish position. But let's look at a potential bullish position. Let's evaluate potential downside. So, like we've talked about earlier in the stream, this downside right here when the market kind of bottomed out a couple weeks ago is really what I like to keep in the back of my mind as potential short-term downside for a stock. And right here it sits at like 68-ish. But what I do like is we see a little bit of a bounce right here off the number, a bounce right above the number right here. And it kind of trades near the number right around here. And yeah, I think there's a little bit stronger of a level down at 68. And what you'll notice when we look at the 68 level right here is it coincides perfectly with where this bounced. So I think 68.5 is a good level to play it off of if we could get the number that we like. So if we look at 68.5, we're not really getting what we want, right? We want a 1% ROR or better, I think, for a lot of these earnings trades. And it looks like we don't get that until 70. But maybe you could take the approach, hear me out, where instead of saying, okay, 70 is the strike we would need for max profit, let's take a look at it from a break-even price perspective. We could get a 0.91% ROR on a 69 strike put, and now 69 would be the max profit level, but with 60 cents of premium, your actual break-even would be like 68.40. So 68.40 would be right about here. And that is almost dead on the bottom from a couple weeks ago, and dead on this level of support right here. So I don't hate the idea of selling 69 strike puts for earnings. And again, futures are red. If this number pulls back a little bit, we could see 1% ROR in this neighborhood. So just because something doesn't look good for an earnings trade on Sunday night doesn't mean that we're going to completely cross it out and leave it off of our list. I think keeping an eye on Micron in the 68, 69 level, if we can get 1% ROR down there, is going to be a pretty solid earnings trade. Now, it is a Tuesday afternoon one, and I don't love the early week earnings trades because, quite frankly, there's just more room after earnings for it to move against you, and it happens a lot. But for this setup, Micron's a little bit more solid of a stock. Go back to the one-year chart. 68 would be from a one-year perspective, 68 is a perfectly acceptable place to own this stock. I don't have a worry about that at all. IB is a little bit elevated right now. I'm perfectly happy with Micron at 68. Now, if you back it up to 3-year, you're going to see something you might not like as much, where you have these pre-COVID highs of 60. But even if we go back down to 60 and we start the position off with like a 67 basis, that's not the end of the world. So, I'm happy to play an earnings trade, and then if it moves against me, potentially wheel it from there. But, that's 3-4 steps down the road. Not that you shouldn't be thinking 3-4 steps down the road when you're entering into an options trade, but definitely something that we'll cross that bridge when we get to it. But I'm happy with step one, which is selling puts in that range. So we'll keep that on the list if a little bit more premium comes into those. Next is going to be Lululemon, which I think trades at a very, very expensive price. So we'll try to make this one quick. 321, we've got that 3-year chart right there. It looks like there's decent support right here at 290. Really like that support level. Pre-COVID highs, which are a level we've seen a lot of stocks retrace to, is down to 262. Let's bump it into the 180 day right here, which had a huge fall down from 45 to 278 before rebounding up to 321. Go to the trade tab, plus or minus 24 right there makes it real easy, right about 290-ish on the bottom side. I still have my arrows right here. Whoops. 290-ish on the bottom side, and then 321 plus 25 is going to be what, 346. Let's try that on the top side, 346 right there, and there's our expected range. So what we do, we right click these things, we extend them to the left, we do what we got to do, we finish out the drawing, and we'll see what I like a lot more. Actually, this one looks pretty decent from a perspective on the upside and the downside, just from an option seller perspective. Whatever it is you may decide to do, we'll bring the handy dandy arrows back out. We see a little bit of resistance right here that intersects nicely with the top line. We see a couple levels of support that kind of respect the bottom line right there. And yeah, it does have a little bit of support just above, but this is a decent little area where we see a little more chop around the top line right there as well. So we have, 1, 2, 3 different places on the downside. Maybe this one right here, but it kind of broke a little bit below that 285. On the bottom side, and then, 1, 2, dropped before it even got there. So really 3 areas of resistance you could point to on the top side. And I think what we've seen more often than not lately with things that have really sold off is when they have good earnings, they tend to pop pretty decently, right? Nike was a good example where it jumped up pretty high. And I think we had the expected move plotted for this one as well, but this is a great example of why we used the expected move, because look at that, it's just chilling right in there. It's chilling right in the middle like nothing ever happened. But right back to Lulu really quickly. This is the range. I think this one sets up nicely. Go back to the 3-year chart. Few points we want to keep in mind, and that's point 1, which is right here. The pre-COVID high of roughly 2, what's the high on that candle? 266 is what we want to keep in mind. And if we zoom in a little bit further, the low from a couple weeks ago, 278. So 266, 278 are 2 key levels that we're going to want to keep in mind with Lululemon. Let's see what we can see around those levels, right? And 266, 275 doesn't look like we could really get anything. 290 is the level it looks like we're going to need to go to. And that's a little bit too close for comfort with me being right on the edge of that expected move. Now, from a mathematical perspective, if that's the approach that you wanted to take to this trade, it works, right? And a lot of these trades, that's the point of these trades, right? If you sell something outside of these lines, it works more often than it doesn't, and those gains really, really add up. So it should work, but what I really like, and getting back to the point that we made with our overall portfolio for the coming week, is we love the big cushions. We love the big cushions. So we've seen earnings trades in the past where we've been able to get much, much bigger cushions. So let's just hang patient and wait till we could find one of those. It's not Lululemon right now. And then the very last trade that we potentially want to talk about for earnings this week is going to be BlackBerry, which is on Thursday. And as far as, the week progression is concerned with earnings, I love Wednesday after close and after. Why is that? Because if you play something Monday or even Tuesday, you have Wednesday, Thursday, Friday for it to move against you. That's 3 full days of price movement. And in a volatile market like this, that's enough time where, you could be right on earnings. And then if you stay in that position, it could just completely move against you and you'll lose the gains. When you play things Wednesday afternoon or later during the week, you find yourself in much more of a pure earnings trade, meaning that with BlackBerry, after close, they report. So really, there's only one trading day. It's Friday, where the stock can move. So it's much more of your results are purely based off of earnings while still maintaining decent implied volatility, because a lot of these stocks with elevated implied volatility for earnings, it keeps that implied volatility until earnings are over. So the fact that it's moved through the week like theta decay really isn't much of a concern or consideration. So for BlackBerry, 739, huge range over the last 180 days, right? Let's see what the MMM says. It says plus minus $1. I love that. That is fantastic. We're starting to see some of the volatility that we like to see to set ourselves up with a very big earnings cushion. But let's chart that, right? It's at 739. This math's a little bit easier. Let me remove all the drawings. Remove all drawings. Yeah. Perfect. So let's get our lines back. And it kept my arrow. How polite of it. I don't want it, but there we go. So $1 higher is going to be $8.39. And $1 lower is going to be $6.39. So there you see it right there. And if we zoom in right here a little bit closer, we start to see what we like to see, right? Drawing tools on the upside. You've got resistance right here where it intersects. It didn't give me my arrow. Why didn't it give me my arrow? Give me my arrow. There we go. Boom, right there. I don't know how to make the arrow go down. I'll figure that out for next week. But right there, intersects with the top. It respects the bottom a bit right there. Does break through. I'm worried a bit about the 564 downside that we saw right there. But can we get anything that gives us a break even below 6 and 1% ROR? Look at this right here. I love the 6 strike put for BlackBerry earnings. Historically, if you own this stock at 6, not a terrible place to be, right? I mean, the last time it was below 6, 3-year might be overkill. If you look at the 1-year chart, you are smooth sailing with this chart and a 6 basis. So if we could get 6 cents or more, and I know it seems so crazy because sometimes commission can jump or cut into these so much when you're selling an option for 6 cents. But if we're able to do so, and we could get greater than a 6 or a 7 cent credit on the 6 strike puts, I'm really a big fan of that, to be honest. It gives you a basis down below 6. More importantly, it gives you a strike that's outside of the expected move decently. And from a overall perspective, if we look back at that 1 year chart, it's a decent price to own the stock at. $5.93 basis on BlackBerry shares isn't going to kill you. So that is it for that. And that is it for our little earnings discussion. So I like Micron. I like BlackBerry. Keeping an eye on the 68 to 69 range on Micron and like the 6 strike put range for BlackBerry. Again, futures are red right now. They could look totally different in the morning, and we could have a totally different situation where prices are different, premium are different. But I think that's a general overview for our game plan for earnings for the coming week. And again, we took a look at the scanner. I think Sofi was maybe interesting, but definitely a bunch of names where I'd like to see a little bit more premium in them before pulling the trigger, especially with how overbought the overall market is after we've had a 5.67 and a 1.84% week from the S&P 500. That is out of character, and what it is typically those big green spikes of big green weeks are more indicative of a bear market than anything else. So I'm remaining cautious, only using a third of the buying power, setting up an average cushion on our trades of 11.28%. And again, even with those big cushions, only using a third of my buying power, with these positions, we're still in line to take home a 2.29% return or $3,722. We try to keep the train rolling for the upcoming week. But again, we can only come up with so much of a plan on Sunday nights. We are going to be active, as always, in the Discord server, calling things out as we see them and integrating some technology to have some bots call things for us. So we don't have to always be glued to a computer. The ultimate goal here is financial freedom and freedom from your computer so you could go outside and enjoy life. Or if enjoying life for you is playing games on your computer, you could do that instead of having to sit in front of your brokerage screen. Whatever, we are just trying to give you strategies that free up time to do whatever it is that you would like to do. But for those of you who are still on, thank you for joining us for yet another Sunday night. And you know what? I think the webcam may be getting a little bit closer. The webcam may have to come up on a stream here soon, but thank you for sticking with us on a little bit longer of a stream on another Sunday night. We did not get to 30 viewers. I'm going to do a better job publicizing these, so hopefully we could have one of our little HT giveaways again sometime soon. Itching to give away some more tumblers. And for those of you who did previously win the giveaways, I've shipped those. So if you get your tumbler anytime soon, please give me a shout out so that I know that they got where they're supposed to get. I honestly do not use the mail very much, so I hope I did it correctly. We will see. But I think we had another really good stream. I think we've got another really good game plan. We're set up for a low-stress week, and if the week does come to a point where things do become stressful, it's going to be because there is a big drop in the market, and there's a silver lining in that if there is a big drop in the market, we have a lot of buying power at the ready to jump into some more favorable positions at hopefully better strike prices and better premiums. So until next time, this has been the Hourglass Trader, where as time passes, we make money. Thank you guys, and hopefully we see you again same time next week with more money than we have right now. Again, hourglass-trader.com if you are watching and want to join our community. Free to join the Discord. Very, very cheap on a monthly basis to join our HT Premium membership. I think it's $25 a month or like $225 a year. And again, just one of the trades that was called out last week. It was the only trade called out last week, in fact, was this $300 Newegg position. So that would have paid for an entire year of HT Premium for you. And now that we're going to have some bots working for us, I think it's definitely a good value for what we offered. But those of you who are on and those of you who are already joined, thank you so much. I really appreciate the community, and we're going to do everything that we can to improve it over the next few weeks. But thank you guys for watching, and we will talk again stream-wise next week. We'll always talk day-to-day in the Discord, but we will talk again live next week. Thank you guys.